Look at your phone right now. You probably have a piece of software sitting on your home screen, glowing neon green, or maybe stark dark mode black with crisp cobalt blue accents. It throws confetti when you wire money into the account. It congratulates you. It gamifies the layout so your uninvested cash looks stagnant, pathetic, inefficient. It uses the same psychological color palettes and friction reduction algorithms developed by casino engineers in Las Vegas. Pushing a button to buy a naked zero-day-to-expiry option feels identical to pulling a slot machine lever. We look at this and we think we are participating in the American economy. We log in on lunch breaks, sitting in our cars, and we think we are outsmarting Wall Street. We tell ourselves we democratized finance because there's zero commission on the trade. You didn't break the gatekeepers, you built them a bigger palace. 90% of retail traders lose 90% of their capital in 90 days. The industry calls it the 90-90-90 rule, cold physics. You log on to Reddit, you see one guy turn a stimulus check into $500,000 on Dogecoin, and you think you're looking at a functioning market. You are not looking at a market, you are looking at marketing. The statistical outlier the house lets win, just loud enough to keep 9 million quiet losers feeding the machine. This is the gamification matrix, a structurally perfect psychological cage designed to extract liquidity from the working class by disguising casino mechanics as white-collar trading. The app charges no visible fee, it feels free. It is a lie. If the product is free, you are the product. In the financial markets, you aren't just the product, you are the meal being eaten by predators. Strip the neon paint, look at the actual plumbing. To understand why you always buy the peak and same the bottom, you have to accept you are sitting at a rigged table, and the table was built over 100 years ago, long before the iPhone. The blueprint for this trap is ancient. Turn the clock back 1 century, the 1920s, roaring bull market. Everyone from shoeshine boys to taxi drivers was getting rich on unregulated margin loans. And all across America, slick new storefronts opened their doors. Polished mahogany desks, heavy brass railings, loud ticker tape machines clicking endlessly, identical to the ones on the real exchange floor. Giant chalkboards tracking the Dow in real time. Men in sharp suits smoking thick cigars, screaming orders, looking like masters of the universe. They were called bucket shops. To the average man walking off the street, a bucket shop looked exactly like a real Wall Street brokerage. You walked in, put $10 down on margin, bought a paper share of General Electric. The clerk smiled, wrote you a watermarked ticket, handed you a receipt. You sat in a velvet chair, drank their free coffee, and watched the ticker spin. If GE went up, you got cash. If it dropped, your margin was wiped. But there was a catastrophic secret operating inside the bucket shop. When you handed the clerk your $10 to buy General Electric, that order never went to the New York Stock Exchange. The stock was never purchased on your behalf. Your name was never written on a ledger anywhere. The clerk took your buy order, walked into the back room, and threw your paper ticket in a garbage bucket. The house knew retail traders are emotional, easily panicked, and ignorant of statistical variance. Over a long enough timeline, the retail trader panics on a dip, over-leverages at the top, and blows up their account. So the house took the opposite side of your blind bet. If you somehow won, they paid you out of pocket. But because they knew you'd lose 90% of the time, they kept your money as pure profit. You weren't in the economy, you were playing a private, unregulated casino game disguised as a stock trade, betting directly against the house, and the house always wins. These operators were so ruthless, they would manipulate the data feed itself. If there was a delay in the Western Union wire from New York, the bucket shop saw it first. They'd wipe out retail margins by triggering fabricated price drops on the chalkboard, stealing the cash before customers realized what happened. Jesse Livermore got his start in bucket shops. He noted the house wasn't there to execute your trades. The house was there to bleed the customer dry without them noticing the wound. By the 1930s, the Great Depression ended the charade. The SEC stepped in. They outlawed bucket shops, made it a federal crime to pretend to route a stock order while internalizing it and taking the other side against an unsuspecting retail client. They mandated public exchanges where every order had to compete in the open market to find the best price. The bucket shop was killed, a dark, parasitic relic of Wall Street history, until Silicon Valley resurrected it, gutted the mahogany, gave it a sleek UI, a neon debit card, and moved the entire mechanism into your pocket. Today, right now, you open your trading app, swipe up to buy 100 shares of a volatile electric vehicle stock. Zero commissions, confetti fires, dopamine hits. But look at the microsecond between your finger swipe and the execution confirmation. Your order does not go to the NYSE. It does not hit the NASDAQ tape. It is hijacked, bundled with millions of other retail orders, routed to a private server rack in Secaucus, New Jersey, a secretive execution venue, a dark pool. A high-frequency market maker like Citadel Securities intercepts your trade. Why? Because your commission-free broker sold your live trade data to that mega fund. This mechanic is called payment for order flow, PFOF. The mega funds pitch to the app. We know retail traders are statistically terrible at this. They buy high, they panic low, they trade on emotion. We have rooms of supercomputers connected to microwave towers that can outtrade a human by a fraction of a millisecond. We want that retail flow so badly, we'll pay you hundreds of millions a year just to intercept those orders. So your broker routes it to the mega fund. They internalize the trade, just like the 1920s. They match it against their own private inventory. They take the other side of your bet. They clip a tiny fraction of a penny, the bid-ask spread, on every single trade. 10 million retail traders flipping options while sitting on the toilet. Those fractions add up to billions in risk-free profit. Let that sink in. An elite hedge fund armed with PhD physicists is paying hundreds of millions for the right to take the other side of your trades. They are the modern bucket shop. They made it legal by promising the SEC a price improvement of 1/10,000th of a cent. What they omit? They are farming retail anxiety, front-running the public market, and locking your order in a sandbox where they have complete architectural visibility. If PFOF didn't exist, these brokers would have near zero revenue. The entire valuation of these gamified apps relies on selling your retail movements to megafunds. You are not on a democratic market. You are wandering into an algorithmic meat grinder. Look at 0DTE options, 0 days to expiration, the most explosive, toxic instrument ever pushed on retail traders. The apps highlight them in bright green. Why? Because the bid-ask spreads on 0DTEs are wide. The market makers print free money every time a retail user clicks buy. You think you're predicting the S&P based on an inflation headline. You aren't predicting anything. You're paying a permanent toll. This is an extraction mechanism designed to drain wages from the working class and deposit them onto the balance sheets of Wall Street market makers. This channel rips the veil off modern financial algorithms. We decode behavioral traps. We break down the hidden math. We expose the structural plumbing so you don't fund someone else's super yacht with your labor. If you want to understand how the deep gears of the system turn, hit subscribe right now. Don't be the product. Break the matrix. So how do you win? How do you fight back against a trillion-dollar alliance of supercomputers and behavior hacking UIs? Stop playing their game. Exit the matrix. Reject the gamification of your financial life. There is a concept in generational wealth called the boring money protocol. Real wealth creation is not supposed to trigger a dopamine rush. It is not supposed to shoot confetti on a Tuesday morning. True wealth creation is painfully boring, watching thick paint dry on a concrete block. First, migrate your capital. Delete the neon apps. Move to legacy, unsexy brokerages, Vanguard or Fidelity. You want an interface so clunky, so boring that you dread logging in. You want friction. Friction stops emotion. Emotion destroys capital. Vanguard doesn't want you trading rapidly. Vanguard is owned by the funds themselves. Investors are the ultimate owners. They eliminated the conflict of interest at the root. They don't need to sell your order flow to keep the lights on. Second, stop feeding the market makers entirely. Stop trading speculative tickers. Stop chasing meme coins. Stop touching naked options. Buy broad index funds that systematically buy the entire capability of the American economic machine. Set an automatic deposit once a month, then close the laptop and walk away. When you buy a broad market index fund, you stop trying to outsmart Citadel's computers in an arms race you cannot win. When you buy and hold, you eliminate the drag of the bid-ask spread. You cut the mega funds out of your equation. They can't bleed your margin if you never trade. The math is ruthless. A day trader staring at 6 monitors for 12 hours a day will almost universally underperform a quiet guy who bought VOO in 2012 and went fishing for 10 years. Your attention is the only thing the algorithms fear losing. Stop giving it to systems designed to make you panic sell. Buy the haystack, ignore the needle, starve the bucket shop, because the only way to beat a rigged casino is to refuse to walk through the front door.